faint heart, right? You guys are learning that firsthand. The partnership tax is what distinguishes the meat from the whatever the cliche is. So, our book. We make good use of the new textbook, right, guys? So, if you really put in the time, energy, and effort after the exam, not before the exam, pat yourself on the back of having to master some of the more challenging information in tax. So, let's just quickly review because I want to make sure we get done with a certain amount tonight, where we are. And since I will argue, you've heard me say throughout that LLCs are probably one of the most popular ways of doing business. Anyone who wants to actually practice tax has to have a good command of this area, okay? So this is imperative for your professional career, guys. Bear that in mind. So just generally, as we rush through these chapters, just to make sure we get through what we need to tonight, Chapter 1 should be really coming easy now, right? Hopefully, fingers crossed. Formation issues. We're noticing, in some ways, formation issues, what we're learning as we liquidate this partnership should be somewhat an affirmation of what we saw with the formation issues. This notion of Congress is going to be patient, that when you form a partnership, there's generally no tax effects, except, Brian, when might there be a tax when you form a corporation? Listen to me. When you form a partnership, sure can. Any tax on formation? No tax, never. Kevin? Oops, they call you chewing. Yeah? When is there a tax? Is there a tax ever on formation? Say again, George? You contribute? Well, services, well, you contribute services, yeah. You're going to have possibly a tax, but what else? When you contribute just property. And this apt, Jonah, right, often happens when you form a partnership. So I want you to be super sensitive to this issue, right? Tinkle as well. Which is when? No, but come on, guys, you got to nail this. Right, Mike. You say, yeah, subject property subject to a liability, right? You could be shedding some of that liability, and you don't want to just write that email right before you go out to lunch and say to someone, it's your day. Never a tax when you make a partnership contribution, right? Because your clients will take that and run with it in a dangerous way. So my point, right, Mike, no one should forget that, yeah, I mean, tax, guys, general concepts aren't where you're paid the big bucks for. It's for you're paid the big bucks when you know the little stuff, when you can say to their clients, hey, generally non-taxable, but be careful, if you contribute property subject to a liability, it could give rise to tax. And that dovetails with some of the stuff we've been studying recently, right? Partnership distributions, right? And you get cash distributions in excess of your basis. What happens? You recognize the gain, right? We saw that. But now, so in chapter 2, we saw it in your head spinning because, you know, it's your first time looking at it. But by this point in the course, you're like, oh, chapter 2 makes more sense now because when you shed a liability and it's considered tantamount to a cash distribution, you're like, oh, I saw that already, right? So it's an affirmation. Everyone agree? And you're going to be very careful, whether it be in this classroom or outside the classroom, to be careful to that issue. That's where a lot of people blow it. All right? You keep malpractice attorneys very busy. You don't want to be part of that, part of that team. All right? All right, so we looked at chapter 2, chapter 3. We looked at general operations of a partnership. Generally, partners get taxed on their distributive share, right? Their outside tax basis goes up, If they make money, their outside basis goes down. If they lose money, distributions generally don't give rise to taxable income, right? If the distribution doesn't exceed their outside basis, right? So we saw that. We saw the limitation on partnership losses, which is something that's a reminder to everyone in this room. And you can't take losses in excess of your basis. You have the at-risk rules 465, the passive loss rules 469, and we're blessed with Code Section 461L, this new loss limitation rule. All right? Then we took a look at partnership allocations, and I know George just came tonight, so I could say, what do we need, George?
Substantial economic effect.
Substantial economic effect. So years from now, you will remember George said, substantial economic effect, and he said, virtually anything goes as long as there's substantial economic effect, but sometimes there isn't substantial economic effect because partners do not want to be unlimited liability, so there will be a qualified income offset, okay? And sometimes there won't even be economic effect, right? Jacqueline, there won't be even economic effect. And when will that come up, do you recall? Non-recourse, right? And what do you need as a quid pro quo? And I say that, you heard it this morning on the testimony, you'll hear it today, right here. There's no cameras rolling. Well, there's one camera rolling, I guess. But Jacqueline, what do you need to make it work? What do you need? Peanut butter and jelly. Kevin has his hand up. Minimum gain chargeback. You're not quick, Kevin. You lose it on the draw, right? You need a minimum gain chargeback, but non-recourse deductions generally have no economic effect, right? All right, so we took a look at those allocations. Everything was, I'll say, cool, and the sky was the limit, but then we learned in chapter 5 that sometimes it's not, right? That certain allocations there's certain overriding rules with respect to contributed property that under 704C that they'll be pegged with the embedded gain and embedded loss. Depreciation deductions may have special allocations, again, that you can't specially allocate it. It has to go to the person contributing the property. And in the family context, Congress always has its antenna up, and sometimes a partnership's interest varies throughout the year. So that was chapter 5. We have our general rules under 752 with respect to partnership liabilities, whether they be recourse, right, versus non-recourse. If they're recourse, we have a hypothetical where the partnership generally, you look at if all the assets became worthless, who would bear the burden of those losses? And with respect to non-recourse, there's several tiers, but most often it's looked at by profitability. Compensating the service partner. We saw this came in generally 3 flavors: distributive share, partner treated as a non-partner, 707A, and a guaranteed payment, 707C. All right? And if the partner does perform services for the partnership, Jacqueline, you get the honors twice in a row. If you get a capital interest taxable or not, to say it loudly. Capital.
Capital is
Taxable. Profits interest? Generally not. Be careful about not. Because again, there are exceptions, and your clients will play games with you if you give them too much leeway, right? So, we talked about that. We talked about the cases. Chapter 8 talks about property transactions between partners and partnerships, all right? And how that's treated. And again, you have to have a sensitivity check, right? With respect to any time there's so-called related party transactions, Congress says to be careful. And there's various code sections that may disallow a loss or may change the character of a gain from capital to ordinary. So you have to be careful about those, and sometimes Congress even treats distributions as if they were disguised sales between and among the taxpayers. We talked about chapter 9, sales and exchanges of partnership interests. We talked about, notice how that chapter is bifurcated, the effects to the selling partner. We talked about our three-step dance move, right? Computing the gain, pulling out the 751 portion, and then the balance 741, right? Right. So we took a look at that, and then we took a look to the buying partner. And generally the buying partner there's not much of an effect, meaning the buying partner has a cost basis and an outside basis equal to the purchase price. And there's no effect on the so-called inside basis, except Gory. When is that not true? You can pass either way, but Julia or Simi, either one. What is that not true? Say again? Julia? Any effect when you buy a partnership interest, Isabel? Or Vince? Vinny? You buy a partnership interest, any possible rippling effect, Tom? 754 election. If there's no 754 election, no rippling effect. If there's a 754 election, the inside tax basis may change. Okay? Okay, so we talked about that, and then I warned you, about operating distributions and the fact that you really have to know these, and that there'll be several exam questions about when the partnership makes the distribution, what is the partner's basis in the assets it receives. So have a good handle on that. We talked about mixing bowl transactions. And a favorite topic, no doubt, of virtually everyone in this room, 751B, which is near and dear to the heart of many, where if there's a disproportionate distribution, you have to go through the machinations of having a phantom distribution, followed by a constructive sale, followed by an actual distribution. All right? So, fortunately, in these problem sets, for example, we keep the fact scenarios pretty straightforward, but you can imagine in a complex partnership how 751B could wreak havoc in computations. So, just keep that in mind. All right? Chapter 11. We talked about liquidating distributions and how liquidating distributions are generally categorized under 736, right? Code section 736. And Nikki, maybe you could tell us, in general, how would you tell people, clients, how does code section 736 apply in general? Troy, you're not ready to speak to the client? 2 weeks from now, you'll be ready to speak to the client? Ron, you want to speak to the client?
90% of the time, it'll be 736B.
But I'm a client. I don't know. What is 736B? What does that mean to me as the client?
It depends if it's a service partnership or a capital.
Keep talking. I'm the client. Help me out here. And what are the implications? Okay, you want to chime in? Just say it loudly. The people at WebEx will get mad at you. Hopefully not me. What is 736A? Treat as ordinary income. What does that mean? How do you know it applies? All right, say again? Okay, capital is not material, it's a service partnership. What kind of assets does it apply to? Premium, what else? Accounts receivable and? Unstated goodwill, right? Unstated goodwill, the appreciated portion of the unstated goodwill, right? All right, so just bear that in mind. That's when 736A applies. I think, David, I asked you last time, I think, but I don't remember. Does 736A ever apply in any other context, or just the context EK described? Or maybe it was Francisco, right? Does 736A apply in any other context other than as EK described, the service partnership? Ben, you had your hand up?
Yeah, it could also be a non-general partnership, but a capital partnership, and it could pre-pay to liquidate partner.
All right, so any premium payment, right, paid in with respect to any partnership, any premium payment payable with respect to any partnership, right, could be a 736A payment, right? Everyone agree? Then, so on one hand, it seems very narrow, right, only applying to general partners of a service partnership. But it could apply, or it does apply universally to any partnership in which there's a premium payment made. Okay? Now, if you're the partner being liquidated, and do you want a 736A or do you want a 736B payment? If you're the partner being liquidated. Say it loudly. Why? I'm sorry? It affects the partner, but just tell me I'm the partner, so tell me how it affects me. You gotta just take it one more step, right? Mike, you have your hand up? It will more likely give rise to capital gains, where conversely, a 736A payment will give rise to ordinary income. But the partnership as an interest which is directly opposite, the remaining partners would prefer the payment be a 736A payment because the remaining partners secure a deduction, and they have less preference for 736B because it's not going to help them out, right? Right, so again, 736 is not a taxing provision. The vast majority of times 736B applies, and the normal rules that we saw when a partner's interest is purchased would apply. Namely, they would have a combination under 751 and 741 of capital gain and ordinary income. All right, and then we finished chapter 11. Chapter 12 deals with partnership terminations. The whole spaghetti is coming to an end. Okay, so we're going to look at that. And then we're going to look at the death of a partner, and I'm going to use some of the problems there because they're going to help illustrate some concepts that we've seen throughout the semester. Okay, so I will highlight those things that I think are relevant and those that may not be so relevant. All right, any questions, concerns, issues? Just by happenstance, guys, you have the good fortune that spiritually we will be here next week, spiritually, okay? But physically we will not. And our exam is 2 weeks from today, so if you could come possibly 10 minutes early, I may have you guys line up alphabetically, and because I may be the only one here to administer the exam and try to seat you alphabetically. So I'll send an email and post it on Blackboard. I will be around. I am giving a presentation, lucky me, in Tampa on Friday and Saturday about gift tax of all things. So I will not be available Friday and Saturday, but I will be available but for those 2 days any other time you need me, okay? Even then, at night, it's only one night, I'll be available. So if you get stuck, just letting you know, during the day, Friday and Saturday, it's gonna be tough just because I gotta give these presentations. But aside from that, I'll be around. Just keep in mind, starting today or starting tomorrow or starting soon, I don't know exactly when, student evaluations will come out, so you guys could take 2 minutes to fill that out, it'd be great. For those people who watched on WebEx or those people watching tonight on WebEx, if you have any ideas or suggestions, you know, I'm gonna try to make this better and better experience for those people on WebEx, but just trying to get used to the lay of the land. So you guys are some of the first. I will tell you though, I am twisting everyone's arms in the program who teaches for me to say they must do their courses simultaneously on WebEx. So I'm trying to make sure that we put a premium on accommodating students. So just to let you know, we're trying to transition into finally the 21st century. All right, so I'll keep you posted on that. But you guys can keep me posted even if it's not my class. If you're having a professor who's recalcitrant, just send me an email. All right, any questions or issues? I'm gonna make it up, probably about 30%, something like that. I don't want to say definitively, not definitively, but somewhat. And then anyone, movies or anything? Someone called me up today and said I had to see. Did anyone see the Harry Tubman movie? No? Was it good? Renee, you thought so too? Yeah. Okay, so it's going to be on my to-do list. And that person pointed out to me that Harry Tubman is apparently buried in Walburn, New York. And he was going to make a pilgrimage up there. He was so impressed by the movie. He said he had to go up there and pay homage. So, any other movies? Cultural events? Stories people want to convey? No? All right. I'm kind of at a loss for good stories myself this week. It was one of those weekends that sort of just disappeared, and I can't explain why. You guys ready? We'll move on? All right. So let's talk about partnership terminations, guys. And again, I will be around for the next 2 weeks, so any questions you guys have, if you get stuck, do reach out to me, and let's try to put your issues to bed. So beginning on page 419, just keep in mind, code section, if you want to open it up, code section 708 provides that a partnership is terminated only if no part of any business, financial operation, or venture of the partnership continues to be carried on by any of its partners or partnership. So now, remember in the prior chapter, one partner was being liquidated, right? Their interest was being redeemed. Here, the entire partnership is going away. The entire partnership is going away. Now, much of this chapter, right, mirrors concepts we've seen in the prior chapters about sales and distributing property, and again, one of your favorite topics, 751B. So in the revenue ruling that follows, revenue ruling 77-412, you have a two-person partnership. And not surprising, Congress is very sensitive in a two-person partnership, as it would be if it were a 100-person partnership. But even in a two-person partnership, you might have one taxpayer whose income is subject to a high tax rate and one taxpayer whose income is subject to a low tax rate. And they might strategize to distribute some of the ordinary income property to the low income taxpayer and some of the capital gain income to the high, excuse me, if I just reverse that, they could distribute well, they could distribute the ordinary income to the taxpayer in the low bracket and distribute the capital gains to the taxpayer in the high income tax brackets. Well, guess what? Congress saw it coming in, even in that context, where you have a two-person partnership, 751B would apply, okay? So no one's falling off your chair, no one's surprised by that, and that's the only thing this revenue ruling stands for, right? That simple proposition. You can't escape the clutches of 751B, even in a liquidating two-person partnership. In Revenue Ruling 99-6, you have two situations. You'll see on page 422, situation 1 and situation 2. Either could arise. You see in situation 1, A and B are equal partners in AB, an LLC. A sells A's entire interest in AB to B for $10,000. So it's being sold to one partner is selling to another partner. And then that business is continuing, but the partnership is no longer, right? Because it's a single member LLC. It's not going to file a partnership tax return, right? Single member LLCs do not file partnership tax returns. By way of contrast, situation 2, C and D are equal partners, okay, in CD, and along comes E, an unrelated third party, who says, you know what, I'll give you $10,000, and then E's going to continue the business. And the issue is, what are the tax consequences? And generally what ends up happening is, it's treated as a liquidating, if you look on page 424, the second paragraph, is treated as making a liquidating distribution of all the assets to A and B. Okay, so A and B are going to be deemed to have holding each of these assets, and then B is deemed to have acquired A's assets. Okay, so first it's a two-part kind of analysis. First, the assets are deemed distributed to each of the partners, and then in this case, B is deemed to buy A's assets, or 1/2 of the total of the partnership assets. So B is going to have a cost basis as to 1/2 of the assets, and a holding period tacked, right? B's holding period, when B receives the assets from the partnership, right? When B gets a distribution of those assets, B's holding period is tacked in those assets, where the assets it purchases, B purchases from A, there's a new holding period, right? So picture, if you will, B now owns all the assets, half with a basis equal to fair market value because he purchased those assets, half with a holding period which is brand new. And if you look at situation 2, where we have a third party coming along and buying the membership interest from C and D, and once again, you look at the last full paragraph, or second to last full paragraph, I should say, and it's treated as C and D are deemed to have a distribution of the assets, and immediately thereafter, E is deemed to have purchased all the partnership assets from them. So they're going to have 751 and 741 gain. None of this is surprising. To the contrary, it's intuitive. Revenue Ruling 95-37. I've seen this a lot. What do I mean by a lot? You have a general partnership where people have formed something, in my opinion, generally by a handshake. And then in one day they decide, someone says, their accountant, someone says, why are you guys a general partnership? You should be an LLC, get a little bit more liability protection. And the question this revenue ruling raises is, suppose you convert from a general partnership to an LLC. Is that some sort of taxable event? Is that going to give rise to a termination? And the answer is no. This is, in this case, it's treated as a non-event, okay? So if you read the questions, and I have highlighted in red the last full paragraph towards the bottom on page 425, the conversion of an interest in a domestic partnership into an interest in a domestic LLC as classified as a partnership for federal tax purposes is treated as partnership to partnership conversion that is subject to the principles of revenue ruling 84-52, which essentially translates into this is a non-taxable event. And just one final statement here. Look at the beginning of the second paragraph on page 426. In the present case, the conversion of an interest in a domestic partnership into an interest in a domestic LLC that is classified as a partnership for federal tax purposes does not cause a termination under Code Section 708. By the way, okay, Michael chimed in with minimum gain. All right, so guys, the message is terminations, no big deal, been there, done that. Let's just look at this one problem on page 427. Let's see if you guys can nail it shut. All right, the partnership has the following balance sheet as cash, cash receivable, inventory, capital asset. A and B liquidate the partnership. A receives the accounts receivable and the capital asset, and B receives the cash and inventory. Okay? What are the tax consequences? So I don't know, you guys can do it your own way. So just for me, I labeled A got a 1 asterisk to the left for the accounts receivable and capital asset, and B, who's getting the cash and inventory, you could see from a distance, I put 2 little asterisks next to the cash, to the right side of cash, 2 little asterisks to the right side of the inventory, so I could easily distinguish, right? Did I not do that? Kevin?
Yes.
Yes, I feel like a magician up here, right? They always say the integrity of the class. So I did do that. All right, so the question is, okay guys, what tax effect does this have? And this is going to be a liquidating distribution, a terminating distribution as to the partnership. We don't have to worry about Code Section 736A applying. 736A is not going to apply to a termination of a partnership. Now, what crosses your mind here? Say again?
754B,
754?
disproportionate.
751.
Yeah, sorry.
751B, right?
Well,
Don't
whatever.
say it out loud. Viva's onto something, right? It has the aroma, right, of being a disproportionate distribution. Don't give me the number, because this is something, again, everyone here at this stage should know what is the disproportionality. And you can test yourself. Someone's getting too much of something, someone's getting too little of something else. So come up with a number. Don't be passive. Don't just sit there. Write down a number. Those people on WebEx, if you're listening, I'm not even going to go to you. I'm not going to post it, but you can hear and see me. Write down a number. All you people. Milla, Peter. Write down a number. Michael. All the people on WebEx. Type in a number. I'm not hoping a person typed in. If you're awake on WebEx, this is a test. Maybe you just put on WebEx and you're not really listening. So here's my test to see if you're really listening. What is the disproportionate amount? And we'll go to you in a second. Everyone's got to come up with a number. Give me 30 more seconds. so all the people on WebEx hopefully have a number. Okay, let's see if anyone's, no one put down a number. Leon, David, where are you guys? Annie, Albin. I don't think anyone put down a number. I'm waiting for all the numbers. So that's a little discouraging. All right, so volunteers, anyone who says they got the B, you got your hand up.
Well, A gets too much of capital assets, and B gets too much of inventory in the amount of 10,000 each. If you take 10,000 of A's capital asset and give it to B, and 10,000 of B's inventory and give it to A, then it'll even it
So
out.
disproportionality is how much?
Well, 10,000 each, so a total of 20, I guess.
Well, Jonah, would you say the same? Say again, Viva? Julia? Lower tier, Julia?
I think you should get, out of the 10,000 cash. We're talking about eight?
Yeah, we're just talking about this proportionality. A receives how much?
40 of capital.
I don't want to belabor this. B got it right insofar I just would say the disproportionality is not 20, it's 10.
It's 10 each, yeah.
10 each.
Yeah.
Meaning A's getting too much of the 741 and B's getting 10,000 too much of the 751. Why? You look at the accounts receivable and inventory, total 60,000, they should each get 30,000, but A's only getting 20, right? Instead of 30. And the same is true with respect to the capital asset in cash. Is A's getting too much, he should have gotten 30, he's getting 40, right? So what do we do? What do we do? Thank you, Kevin. We give them what they don't want, right? So what does A not want? Doesn't want the inventory, right? So we're going to give him the inventory, right? Okay, we're going to give him the inventory. How much inventory are we going to give him?
10K.
10,000 in inventory with a basis of how much? With a basis of 5. Okay, everyone see that? We're going to give A inventory worth 10,000 because that's the disproportionate with a basis of 5. Where did they get the 5? Because we know the ratio of basis to fair market value is 1/2, right? So what happens in this is that on that constructed distribution, so we're gonna have it, what's gonna happen? A's gonna sell it back to the partnership. Gonna sell back $10,000 worth of inventory, right? So the basis of the inventory goes up. what is gonna be used to buy the inventory, guys?
Capital asset.
The capital asset. And what's the basis of the capital asset?
75%.
What's the basis of the capital asset, guys? $10,000 worth of capital asset,
7,500.
7,500. Notice the ratio.
I can't see right after 2020, 2030.
Okay, I'll do it below. Okay, so two things are gonna go on here. First of all, we're gonna distribute to A, $10,000 worth of inventory with a $5,000 basis. And then B is the other remaining partner theoretically. Remember, it's a liquidating partnership, and so he's gonna transfer a capital asset worth 10,000 with an adjusted basis of 7.5. At the end of the day, what's gonna end up happening is A's gonna have that $5,000 of ordinary income, and B's gonna have $2,500 worth of long-term capital gain. Okay, so we have the phantom distribution to A, followed by a constructive exchange, where each one of them is gonna pick up that kind of income. And then we're gonna have our normal distribution. Right, now what assets, right, is A gonna get?
Inventory.
It's gonna get inventory. Now he's getting, what's his outside basis?
35.
Okay, so So let's just take a look one more time. So A's gonna get the inventory, right? And what happens to his basis as a result of getting the cash, guys?
Goes down.
It goes down to what?
15.
How much cash does he get?
20. Oh, no. A doesn't get any cash. B gets the cash.
B gets cash, I apologize. A gets the accounts receivable, right? What basis is assigned to the accounts receivable? Where am I looking for basis, guys? In other words, A's gonna get the accounts receivable and the capital asset. Everyone agree? What code section controls the basis A takes in the assets? What code section controls what A's basis is in these assets? You gotta know this one. What code section controls? Because A has, as we point out, a $30,000 basis. Should that be assigned to the accounts receivable? What code section applies here? 732, right? And how does 732 operate? It has that set of complex rules, right? And generally, whatever the partnership's basis is in the assets, it starts with the inventory, right? The non-capital and non-1231 assets. And here, what's being distributed is the accounts receivable. So the basis to the partnership in that is what? 0. So what basis will A take in that asset? 0, right? He just takes over the partnership's basis in that asset. Agreed? And what basis will A take over in the capital asset? Hold on. The capital asset now has a basis right now of 22.5, but remember, it's a terminating distribution, right? So what basis will he take? I think someone said it on WebEx. Speak from above. Barbara just said it on WebEx.
30.
30, right? Because the partnership's terminating, right? So the basis to this capital asset will become 30. Okay? Now just bear in mind, A's overall basis will be 40. Why do I say that? In other words, A's getting this distribution, right, of this capital asset with a partnership basis of 22.5, but his outside basis is 30. But remember, as part of the 751B transaction, didn't he have to purchase $10,000 worth of assets? Right? Did he not have to purchase that? Right? Because he got $10,000 worth of inventory, and then he purchased $10,000 with that $10,000 worth of inventory. He purchased $10,000, right, of capital assets. Everyone remember as part of the 751B? So his overall basis in that asset is 40. But as a result of the distribution, he takes a $30,000 basis. How about B? So just for your notes, A has no gain or loss. A has no gain or loss, right? Distributions don't usually give rise to gain or loss. What about taxpayer B? Gonna get cash and inventory. So tell me what B's basis is. Does B have any gain or loss? And what basis will B take in the inventory? Say again? You're saying B's basis in the inventory is 15. Anyone else have a different answer? In other words, what basis will B take in that inventory? 25? All right, guys. What's B's outside basis right now?
35.
No. 37.5. 37.5. So what basis will B take in the inventory, guys?
17.5?
17.5, right? Why? Because the cash reduces his basis down to 17.5, right? Everyone agree? The cash reduces B's outside basis to 17.5. And then when the inventory comes out, he can't, even though the basis would have been 25, he only has an outside basis of 17.5. and that's it. So the basis will be 17.5. And just to prove this point, how much potential gain did B have? And you can do this with A as well. When we started this problem, everyone agree? Had a potential gain of 25, agreed? And as a result of the 751B transaction, how much gain did B experience? Remember from your notes? How much gain did B experience as a result of 751B constructive sale? 2,500. Everyone agree? There's $2,500 gain as a result of the 751B, right? B had to report that 2,500. Now we're going to give B inventory worth 40 with a basis of 17.5, right? What's the gain lurking in that? What's the embedded gain in that? 22.5, right? Everyone agree? The gain lurking in that inventory is 22.5. Guess what? Mystery solved. What's the overall gain, guys? 25. And I'm sure you could do with A. I just did it in my head with B, but I'm sure we could produce the same outcome. The point is, you can check yourself. You should be able to check yourself, and everything should come out. No, it should come out just right. Right? Any questions on this? Got news? All right. That's a slow nod. Folks on WebEx are chiming in. Hopefully they have. Neil, I don't know what the 35 relates to any longer. So you type in a number, just type in what you think what it relates to. All right. So termination event, guys, the takeaways, very similar to things that we've learned, but you've got to know the earlier rules, right, with respect to operating distributions and liquidating distributions in 751B to put together a complete picture, right? All right, so I told you that in my mind that we were going to skip the rest of this chapter. Why? Because if we talked about the incorporation of a partnership, we would have to do a deep dive into various code sections in the realm of corporate tax that I'm not sure everyone here would feel comfortable with. So I didn't want to introduce a whole new array of code sections that might come up. And then partnership mergers and divisions, once again, I thought overly complex for our purposes. So I thought that we could skip that and I would not do any damage to you guys. I do think chapter 13 has certain principles that we can go through, and hopefully in some ways it will serve as a reinforcement, affirmation of principles we already picked up. So let's talk about chapter 13. And there's some neat concepts that I think they're neat, that apply universally to all of tax, so that I think you should pick, just generally good tax information. All right. So, the death of a partner. Sadly, you have a partner, dies, and the issue is, what are the tax consequences? And there's many different dimensions to look at, and there's a lot of questions when a partner dies often. Does that partner's interest go to, or held by the estate? Is it bought out by the remaining partners? Is it going to be transferred immediately to family members? A whole bunch of issues and questions. And often, many of these involve, if it was well done, some sort of operating agreement. Why? Because in the absence of an operating agreement, we all know in this room, valuations issues are really challenging, right? So having an operating agreement really obviates the need for all the confusion that would otherwise possibly surround the issue of valuation. So here you can really add value for your clients by insisting that they get an operating agreement in place, all right? It's really pivotal, because if you have a 3-person dental practice, and sadly one of the dentist dies, and the revenue of the dental practice is $3 million, obviously I'm making this hypothetical, but the surviving spouse may say, look, my husband died, his interest is worth $1 million, and the 2 surviving dentists say, you know what, no, it's not worth $1 million, it's worth, 100,000. And each one has what they claim to be a very legitimate perspective. So the time to put these things and craft them is when everyone is in good health. And there's a whole bunch of ways of doing buy-sell agreements, from a multiple of earnings to just having the accountant value the property, a certificate. There's just a lot of different ways, but it should be done. Okay, that's my main message. When someone dies, a few different rules come into play. Some of which you're familiar with, some of you aren't. When someone dies, that partnership interest, is it part of the person's estate? Yes. This is the code section 2033. And when someone dies, that interest becomes part of their taxable estate, valued at its fair market value. But does the estate tax apply to most people in 2019? And the answer is no. Why? The exemption is currently, fill in the blank, $11.4 million, right? $11.4 million. New Jersey has no estate tax. State, for example, New York, anyone know what the exemption is in New York?
It's over 5 million.
5,740,000, right? And the federal, if you exceed the threshold, the tax rate is how much? If you exceed the federal threshold, what is the tax rate, Mike? 40%. In New York, it's as high as what? Say it loudly. 16%, but it's deductible for federal purposes. So it's about 10% when you take into account the deduction. So just make the observation that you have possible estate tax. Not for most people. Most people don't have that, net worth. If you're married, obviously that becomes double, 22.8 million, right? So I used to say to people, if you win the lottery, you may have an estate tax issue. Even most lotteries, you're not taking home $22.8 million. All right. Most of us are familiar with the concept of Code Section 1014, right? Basis equal to fair market value rule, right? That when someone passes away, that if you bought Google stock at $10, it's now worth $100. The recipient gets a basis equal to fair market value, or $100. Agreed? Agreed, right? By way of contrast, if someone makes a gift, there's this so-called carryover tax basis rule. What's my authority? Code Section 1015, right? However, that basis equal to fair market value rule is not universal. Code Section 1014C says that it does not apply to so-called IRD. So now you have a new acronym, right, that you should know. Everyone in this room should know. What is the most common form of IRD? The most common form of IRD in existence. Most common form of IRD. Anyone in WebEx typing it in? I don't see any responses. Mike, you're itching to say. IRAs, right? Retirement accounts, right? Someone might have a $3 million IRA. When someone dies and that money comes out of the IRA, it's fully taxable. It does not get a basis equal to fair market value. So even if in the IRA, if Google stock was purchased for $100 a share and it's now $2,000, the IRA does not get a step up in basis, right? The code section 1014 does not apply.
If it is Roth IRA,
It doesn't apply to Roth, there's no basis equal to fair market value for Roths either. But that's moved because the money coming out of the Roth is not taxable anyway.
yeah.
All right, so, but it's not income with respect to the decedent because the whole thing is moved. All right, so, with respect to IRD, everyone gets this concept, right? That items of IRD, monies that have never been taxed before, okay? Monies that have never been taxed before, not capital appreciation, but monies earned, okay, that have never been taxed before, do not get a basis equal to fair market value, okay? So you might say to yourself, how does that apply in the partnership context, okay? How does that apply in the partnership context? And when someone dies and they own a partnership interest, suppose that the outside basis, their outside basis, make up a number, is 40,000. Their outside basis is 40,000, but the fair market value is 100,000, right? Everyone got the visual? Their outside basis is 40. Maybe they did a capital contribution, 721 transaction years and years ago, and their outside basis is 40, but the property they contributed now is worth $1 million, or 100,000, to use my example. And the question is, what would it end up being their tax basis? Now, most people would say, oh, their tax basis increases from 40,000 to 100,000, right? Code section 1014, right? Seems simple enough. And with all their stock, all their appreciated stock, that would be true. However, their partnership interest, or the partnership may contain items of IRD. In particular, may contain two things. Accounts receivable, right? And if they're a cash method partnership, right? Aren't accounts receivable a quintessential example of IRD, right? Accounts receivable, cash method taxpayer. Those monies have never been taxed, right? Right? And there may be embedded in their partnership interest, we'll see, 736A payments. 736A payments also are treated the equivalent of IRD. So we'll see how this comes up. All right? Now, there is a code section. This does not come up with regularity, so let me just call this to your attention. Again, it doesn't come with a lot of attention, just to call it your attention. The amount includable in gross income of the successor in interest of a deceased partner under 736A shall be considered IRD under 691, okay? So it says if it's a 736A payment, it's gonna be considered IRD. That's all the code says here. However, we have two cases here that create common law. They go beyond what the code says. The first is Quick's estate. And in Quick's estate, the partnership had a lot of accounts receivable. Okay. And the position of the partner here is there's no 736A. So when the partner dies, the taxpayer, the surviving spouse, if I'm not mistaken, inherits the partnership interest and would like to take a basis equal to fair market value. All right? Seems simple enough. Invokes code section 1014. Game over. Or at least she thought. But the IRS comes back and says, no, 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 no. With respect to the accounts receivable, the outside basis cannot be increased, okay? That with respect to that portion of the outside basis that relates to accounts receivable, the outside basis. So picture, if you will, you have a partnership, okay? V and Jonah are 50-50 partners. And the only asset of that partnership is $1 million of collectibles, okay? Jonah, sadly, you die, and Jonah's spouse is going to inherit her interest, right? And it's going to be entitled to $500,000, right? And his partnership interest is theoretically worth $500,000, agreed? Because there's a receivable of $500,000, and we could discount it for non-collectability, all that other stuff, but you get the visual. His interest is worth approximately $500,000. But, so Jonah's husband would like to take a tax basis, right? He inherited the interest. He's going to be a 50-50 partner with B of $500,000. What the quick trust case says is no, you can't take, in my very simple fact pattern, Jonah's husband would take over a zero basis in the partnership interest, okay? Would have a zero basis. Receivables, because inventory is not IRD. So, in other words, with inventory, if you bought inventory at $20,000, it's now worth $50,000. You die, your basis in that inventory becomes equal to 50. You there? And if you read the case Woodhall, I think the author, this case was decided 2 years, I believe it was 2 years after the Quick decision. It says essentially the same thing. I'm not sure if the authors needed to have this case here, but it's just a nice affirmation of the Quick case. So even though this is not found in the Internal Revenue Code, it has a certain inherent logic to why the court did this based on public policy. And once again, the taxpayer lost here. Okay. We cannot get a basis increase with respect to that portion of the property which relates to accounts receivable. Okay. Revenue ruling 66-325. We have a case in which Code Section 736A apply. And what do we know if 736A apply? And how are we going to treat it? Is it going to be treated as IRD? And the answer is yes. Okay. In this case, it was clear that there was a 736A payment, and as such, it was treated as IRD, and there was no basis step up with respect to it. And I'm just going to point out on page 460, and we're going to see how this comes up in the problems, that any time you have a decedent taxpayer in a closely held context, a decedent partner, many, if not most times, it's going to make sense to make a 754 election for the partnership. When there, and we're going to see why. So normally when someone dies, does the inside tax basis change? And the answer is no. Let me repeat that. If you had a long day, you may not have heard what I was saying. Just when someone buys a partnership interest, does the inside basis change? And the answer is no, right? That normally when, and Tom affirmed this, when someone buys an interest in a partnership, absent a 754 election, the inside basis does not change. I mean, sometimes the code forces a decrease, you're right. That's a rarity, but you're right. Sometimes there's a mandatory basis adjustment if there's an embedded loss of $250,000 or more. But putting aside that, most times there is not a mandatory basis adjustment. Similarly, when a partner dies, okay, and there's basis equal to fair market value as to their membership interest, the inside basis does not change. But if the partnership has highly appreciated assets, you might want the inside basis to change, right? Because that may prove advantageous for future depreciation deductions and the like. And we're going to see that in a few minutes with the problem. So again, this is going to be affirming hopefully some of the concepts you guys are familiar with. So that's the author's discussion on page 460 about inside basis consequences. Generally, none. But if there's a 754 election, there are consequences. I say tongue in cheek, you know, you hear time and time again, elections have consequences, right? During the past week or two, we've heard that line. And Obama, I think, started that line with elections have consequences. Well, 754, right, has consequences. But in the absence of a 754 election, no consequences. And then just call to your attention as just something you got to be careful about is that on page 461, not surprising, if partnership contributed by decedent with a built-in loss, if you recall, only that contributing partner can avail him or herself when the partnership disposes of that property of the loss. That cannot be inherited or somehow transferred over to the other partner. So I just have highlighted on page 461 under that italicized section, property contributed by the decedent with a built-in loss, the last three lines. Thus, the built-in loss is eliminated when a partnership interest passes from the decedent. Note that the resulting decrease in the partnership's inside basis is in the contributed loss property occurs even in the absence of a 754 election. So it's one of those little strange rules that might pop up. All right, let's see if we can do this one problem and then we'll take a break. And after the break, see if we can just do two more problems and we'll call it a night. But these problems are not, don't take 2 minutes, so be forewarned. They may take a while to go through. So, we have a partnership, is a 1/3 general partnership in DEF. Both D and E, both D and the partnership are cashed by the taxpayer. D dies at a time when the partnership has earned $15,000 in the current year, and his share of untaxed and undistributed partnership income for the year is $5,000. Under all of the sale or liquidation agreements described below, D is to be paid $30,000 for his interest, which includes his share of current income. So, you know, not only, it earned $15,000, so if you look at the partnership capital account, right, everyone see that his interest, D's interest is $25,000, but he has a 1/3 interest rate of the partnership income earned to date. So 1/3 of 15,000 is what? 5. So his interest is worth 30. Everyone agree? At the time of D's death, before making any adjustments on account of the operating income generated during the current year, the DEF partnership has the following balance sheet. Assume alternatively that D's interest, one, passes to his estate, and we'll go through each one of these. So assume D's interest passes to his estate. Consider each of the following 4 questions. So if his interest passes to his estate, does the partnership year close? And this, you might want to open up to 706C2A. It says the taxable year the partnership shall close with respect to a partner whose entire interest in the partnership terminates. So we're gonna close the partnership year. So that $5,000 is gonna have to be reported on his final return. Okay, so the answer to question A, scenario 1, is the $5,000 has to be included on D's final tax return. What is the amount? Just, I'm not gonna test anyone on estate and gift tax, but what do you think you have to include in D's estate? What's the dollar amount? 30,000, right? That would be the amount you would include in D's taxable estate. Just so you know, that's section 2033. To what extent does the interest included in D's estate constitute IRD? Okay, so don't say it out loud. Try to come up with a number of what you think the IRD would be here.
Professor,
People on WebEx, I invite you to give me a number.
quick question.
Shoot.
So the entire the partnership has to file a short year when there's a death?
Not the partnership,
Oh, just the partner.
just the partnership.
So he gets a
K1.
Yes.
Okay.
okay.
So come up with what you guys perceive or think is the IRD. Bear in mind, guys, at least unless you guys see to the contrary, later in the third scenario, we're told it's a service partnership. So let's assume capital is material producing here. So if capital is material producing, guys, what's going to be the IRD here? Not a trick question. What is IRD typically, Ramon?
Since he's a cash basis, it's receivable, so there's no what tax.
So the receivables, right? And he has a 1/3 interest. So the IRD here, right, is 15,000. The 5,000 that he's entitled to is already going to be accounted for in his final return. So the $15,000 is IRD. Okay? So we know that the 15,000 is IRD based on our quick case. Okay? The quick case and I never get the name of it, Woodhall case. So what is his outside basis? Because question D on the next page, 462, says what is D's outside basis immediately following death?
Isn't it 30?
Alright, so his outside basis increases to 30. Is that his final outside basis? It increases to 30, but then you have to reduce it by the IRD of 15, right? So his outside basis goes to 15. Everyone got that? You get a basis equal to fair market value rule of 30, right? That's what his interest is worth at that. But you gotta reduce it by the IRD of 15. So it's 30 minus 15, his outside basis becomes 15. Now, I'm just going to point out to you, everyone agrees, outside basis is 15. If there's a 754 election, we're going to keep it simple. 754 election, his outside basis is 15, and his share of the inside basis in this problem would be 1/3 the cash plus the 5,000 that he already had to recognize, right? Because he had inside basis, right? The total inside basis is 9,000. He has 1/3 of that plus the cash he's going to be taxed on. So the adjustment is $7,000, the 743B adjustment, and you don't allocate the 743B adjustment to the IRD items. I repeat, you do not allocate any of the adjustment to the IRD items. It would all be to the non-IRD items, which obviously is not cash, right? It would be the depreciable property and the goodwill, okay? And if you look at this, you allocate it in proportion to the fair market value, and the depreciable property, if the total value is 21,000, right? And 1/7 is depreciable property, and 6/7 is goodwill. So you would allocate 1,000 to the depreciable property, 6,000 to goodwill. So again, if you do a 743B adjustment, the adjustment is $7,000. Under code section 755, you allocate it based on the proportion of fair market value of these two capital assets. Look at question 2. These are going to be very similar. Suppose it's subject to a buy-sell agreement, okay? So it's subject to a buy-sell agreement. What happens to the 5,000 that he's entitled to? Once again, it's includable in his final return. What value do we include? Same thing. In other words, the partnership year closes to him. You see question 2 under this problem where if it was subject instead to a buy-sell agreement?
Oh, okay,
Okay.
yeah, okay.
So it's 5,000 included in the final return, $30,000 fair market value. Once again, $15,000 of IRD. We're on page 461. And on page 461, they have 4 different after you see the word assume alternatively, you have 4 different permutations. So the first permutation we did, the second permutation, the answers are identical, okay? Whether it be, if it passes to his estate, or if it is part of a buy-sell agreement, the outcome is gonna be the same. What happens in 3, if the interest is liquidated by the partnership, now we're told it's a service partnership. So if you see if it's a service partnership, your antenna goes up, right? what code section might apply in this context, guys? What code section is apt to apply?
743A.
Say again?
743A.
7?
43A.
B.
No. 736A.
Oh.
736A, right? Service partnership. So take a look at this. Now that we know that 736A might apply. And let me give you the first two, and then the third part C is the question. So under 3, scenario 3, once again, $5,000 is going to be included in D's final return. $30,000 fair market value included in his estate. And question C, what is the IRD here? Don't say it out loud. Come up with a number. People on WebEx, try to be a little bit more adventuresome. Come up with a number of what is the IRD in this context. Hey, you seem like you're itching to say.
No, I'm not.
Anyone else? Anyone have? Ramon?
21.
21. How'd you get it?
15 from receivable.
All right, everyone agreed. That's the easy part, right? The 15 from the receivables, you can glance at this in a heartbeat and say that's going to be IRD. Everyone agree? No? I mean, you should be able to eyeball that and see that being IRD. Where Ramon's going to differentiate himself from the average Joe is Ramon says, hey, what code section applies here?
736A.
736A, okay? And assuming the goodwill is unstated, right, then it becomes IRD under code section 753. Code section 753 says all 736A payments are IRD. And what Ramon has done is say the appreciation in the goodwill is going to be treated, his portion or $6,000. So the total here is 21,000, 15 plus 6. So our taxpayer, right, is going to be saddled with $21,000 of ordinary income. Don't say it out loud. Everyone come up with a new question D, part D, outside tax basis. Not a trick question. What's the outside tax basis? Ramon, you're on a roll.
9.
9. 30 minus 21, right? 30 minus 21. And what happens if the partnership were liquidated? Part 4, right? In which the partnership is a capital and is a material producing item. So let me answer the first two parts. 5,000 once again included in final return, $30,000 fair market value. So do we have any 736A payments? Do you have any 736A payments, guys? Was that a no or yes?
No.
No, there are no 736A payments, right? Everyone agree? No 736A. But, do we have any IRD? Once again, under this quick case and Woodhall case, even though Code Section 753 does not apply, right, because there's no 736A payments, both of those cases, the quick and Woodhall, says once again, the accounts receivable, right, or is treated like an IRD items. And, no shocker here, what happens to our outside basis? Goes from 30 to what? Goes from 30 to 15, right? 30 minus 15, right? Because the IRD is 15. We have to adjust the outside basis. If you don't adjust the outside basis, de facto, the person would be able to get the equivalent of a step up, right? It can't increase it to 30,000 because, again, Code Section 1014 does not extend there. Does not extend to items of IRD. So why don't we do this, guys? It's 7:33. Why don't we take a little bit shorter break, 7 or 8 minutes. We'll try to keep it a little bit shorter, and maybe, just maybe, we'll get a little bit out early tonight, okay? I can't promise. And V was kind enough. V, do you want to tell us what this is?
Yes, it's an Indian sweet that is not seen in communities outside my own, that my husband just brought from India. And it is made out of lentils, milk, ghee, which is a clarified butter, and it contains, of course, some sugar as well, and it contains some nuts. Nuts are used as a garnish, so if you're allergic to nuts, I'm
Don't
sorry.
do it.
Yeah, if you are lactose intolerant, don't do it.
See, people on WebEx, you don't know what you're missing.
But there's spoons out there, forks out there.
All right.
Feel free to take
And
one,
I-
two,
and
whatever.
I'll to be the first, and if I'm still standing after I take a taste, you know there's nothing lethal here. All right.
Well, it's not spicy.
Well,
so-
thank you for inviting. Thank you, V.
Uh-huh.
Take our break, guys.